Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
All right, get ready to dive deep. Today we're tackling mergers and acquisitions, where billions of dollars are at stake and entire industries can be reshaped. We're going to be using some real-world examples to see how these huge deals really work, from the initial agreement to the sometimes messy process of actually merging two companies.
Yeah, that's the thing. Signing on the dotted line is just the start. What really gets me going is how companies actually figure out what a target company is worth, how they get the money, and how they manage that critical period after the merger.
I guess you'd think valuing a company is as easy as looking at its share price, but there's got to be more to it, right? I mean, it's not like buying a used car where you haggle over a few scratches and the mileage.
Oh, it's way more complicated. There's a whole structured process, a life cycle that companies go through. It all starts with something called deal sourcing.
Deal sourcing.
Yeah, that's where they identify potential targets based on their strategic goals, what the market's doing, and of course, a preliminary valuation.
So they're not just throwing darts at a board full of company names. There's a strategy behind choosing who to go after.
Absolutely. It's all about finding a target that fits their existing business, opens up new markets, or brings valuable tech or intellectual property to the table. And then comes the due diligence and valuation phase, where things get really interesting.
That's where the financial detectives come in, right? Digging through spreadsheets, looking for hidden risks, trying to nail down what the target company is really worth.
Exactly. Financial models are the bread and butter of this stage. Teams use things like EBITDA multiples and price-to-earnings ratios to benchmark the target's value against similar companies.
Kind of like comparing houses in the same neighborhood to get a sense of what yours might be worth.
Yeah, that's a good way to think about it.
But what about companies that are growing really fast or shaking up their industries? Those traditional benchmarks might not capture their full potential.
You're right. That's where discounted cash flow, or DCF models, come in. Imagine you're buying a promising startup. The DCF model helps you estimate its future cash flows and then calculate its present value. You're essentially betting on its growth potential.
Okay, so they found a target, done their homework, and got a rough idea of the price. But how do companies actually pay for these multi-billion-dollar deals? I mean, do they just have vaults overflowing with cash?
Well, some do, like Apple with its massive cash reserves, but most companies have to get creative.
How so?
They can go for debt financing, which is kind of like taking out a giant loan. Or they can use equity financing, which means selling shares of their own company to raise capital.
So debt's like adding leverage. It could mean bigger returns, but also bigger risks. And equity means giving up a piece of the ownership pie. What makes them choose one over the other?
It's a balancing act. Debt financing can be attractive when interest rates are low, like what Microsoft did with the Activision Blizzard acquisition. But taking on too much debt can scare investors and hurt a company's credit rating.
So it's not just about getting the money. It's about choosing the financing method that best fits their financial goals and how much risk they're willing to take.
Exactly. And let's not forget about what happens after the merger, the post-merger integration phase. That's where the rubber really hits the road and the real work of blending two companies begins.
Merging cultures, systems, processes.
Right?
That can't be a walk in the park. It's got to be like trying to fit puzzle pieces from different boxes together.
It can be a real headache. Take the AT&T and Time Warner merger. That was a huge deal, valued at $85 billion.
Wow.
They ran into major integration problems, culture clashes, strategic misalignment. It didn't turn out as well as they'd hoped.
That's a cautionary tale right there.
Yeah.
It's not enough to just buy a company. You need a solid plan to make the integration work. So what are some of the key ingredients for successful integration?
Communication is huge. Clearly explaining the vision and goals of the merger to everyone involved helps minimize uncertainty and resistance. Strong leadership is essential too. You need leaders who can make tough calls and guide the integration process effectively.
So a clear roadmap, strong leadership, and open communication. Those are essential to navigate the choppy waters of merging two organizations.
Absolutely. Another crucial factor is cultural alignment. Companies with similar cultures are more likely to integrate smoothly. Think of it like this. If two companies have totally different work styles, values, and ways of communicating, well, sparks are going to fly.
It's not just about the numbers. It's about the people and how well they gel together. Speaking of numbers, let's look at a case where financial modeling played a crucial role in M&A success. Disney's acquisition of 21st Century Fox.
Oh, that's a great one. Disney's finance team went into overdrive with their financial modeling before signing that $71 billion deal. They carefully projected revenue synergies from expanding Disney Plus with Fox's content library. That move helped turn Disney Plus into the streaming giant it is today.
Combining those content libraries must have unlocked a goldmine of revenue potential. But it wasn't just about more revenue, was it? They also had to figure out the costs of merging those two massive media empires.
You got it. They pinpointed cost synergies in areas like production, marketing, and distribution. Instead of two separate marketing teams promoting similar films, they streamlined things and cut costs.
So they weren't just focused on making more money, they were also focused on saving money through smart integration.
Exactly. And they didn't just stop at revenue and cost synergies. They also carefully looked at Fox's debt obligations to make sure the deal wouldn't hurt Disney's financial stability. It was a really thorough analysis that ultimately helped the deal succeed.
Wow, that's impressive. It's like they were playing financial chess, thinking several moves ahead to see the long-term impact of the deal.
Exactly. And that's what separates the winners from the losers in M&A. It's not just about making a deal. It's about having the vision and analytical skills to see the big picture and plan for the long game.
We've seen how companies find targets, figure out what they're worth, and get the money for the deal. We've talked about the critical post-merger integration phase and the importance of financial modeling. But now let's shift gears a bit and talk about how companies actually structure these M&A deals. It's not a one-size-fits-all thing, right?
Not at all. There are different types of deal structures, each with its own quirks when it comes to taxes, accounting, and even regulatory stuff. It's like choosing the right legal and financial framework to build your M&A house on.
Okay, so like picking the right blueprint before you start construction. What are some of the most common ways companies structure these deals?
One common structure is a stock purchase, where the acquirer buys the target company's stock straight from its shareholders. It's a clean transfer of ownership, but it also means inheriting all of the target company's baggage, their liabilities, both known and unknown.
So it's like buying a used car without a proper inspection. You might get stuck with some unexpected repair bills.
Huh? Yeah, that's a good way to put it. Another common way is an asset purchase, where the acquirer picks and chooses specific assets of the target company, things like intellectual property, real estate, or customer lists. They get what they want without taking on all the risks.
That sounds more strategic, letting companies cherry pick the good stuff. Any other common structures?
Yeah, there's the classic merger, where two companies combine to form a brand new entity. This can create a bigger, more competitive company, but it also means carefully blending operations and cultures. Think of it like two rivers merging into a single, more powerful stream.
Each structure has its own unique characteristics and things to consider. What factors influence a company's choice?
It depends on what they're trying to achieve with the deal. Are they looking to completely own the target company or just acquire specific assets? The financial health of both companies is important too. Can they afford a full acquisition, or is a smaller asset purchase more realistic? Then there's the whole world of tax and regulatory considerations that can make one structure more appealing than another.
Sounds like you need a team of lawyers and financial advisors to navigate that maze and find the perfect fit.
Absolutely. Choosing the right deal structure can make or break the whole thing. It's not a decision to be made lightly.
This deep dive is already more complex and fascinating than I imagined. We've explored the different stages of the M&A lifecycle, from deal sourcing to post-merger integration, and we've dug into the complexities of financial modeling and deal structures. But there's another big piece of the puzzle: regulatory bodies.
Ah, yes, those government agencies, always watching. They have a big say in how M&A works, making sure there's fair competition and protecting consumers and investors.
It makes sense. These deals can really shake up industries, so it's important to have some oversight to prevent monopolies or shady practices. Who are the main players in this regulatory arena?
In the U.S., it's the Department of Justice, or DOJ, and the Federal Trade Commission, the FTC. They're the ones who review proposed mergers to see how they might impact competition and consumer well-being.
So they're like the referees, making sure everyone plays fair.
Exactly. They can block deals if they think a merger will create a monopoly, stifle innovation, or hurt consumers. They're the guardians of fair competition.
That's got to make companies think twice about anti-competitive mergers. Do other countries have similar regulatory bodies?
Oh yeah, many countries have their own competition watchdogs. In Europe, the European Commission does a similar job to the DOJ and FTC.
So companies doing cross-border M&A have to navigate a whole web of regulations. That adds a whole other layer of complexity to an already complicated process.
You bet. Getting regulatory approval can be a long and winding road, requiring tons of paperwork, legal expertise, and often tough negotiations with government agencies.
Sounds like companies need to be ready for a marathon, not a sprint, when it comes to regulations.
That's a good way to put it.
We covered a lot of ground in this first part of our M&A deep dive. We've seen how these deals work, the financial nuts and bolts, the importance of integration, and the role of those regulatory bodies. Even seemingly simple deals can be incredibly complex and nuanced.
It's true. There's always more to discover, more layers to peel back. Before we move on, I want to go back to something we talked about earlier, the human side of M&A. It's easy to get lost in the numbers and the deal structures, but we can't forget about the people.
That's so true. It's not just about spreadsheets. Mergers and acquisitions can really shake things up for employees on both sides. There's uncertainty, fear of losing jobs, and the challenge of adapting to a whole new work culture. How can companies handle this human element better?
Being transparent is key, keeping employees in the loop throughout the process, addressing their concerns head on, and communicating clearly about the integration plan. Those things can really help reduce anxiety and build trust.
So it's about treating employees like they're part of the process, not just cogs in the machine.
Exactly. And it's not just about communication during the merger itself. Companies also need to invest in programs that help employees adapt to the new organization, learn new skills, and feel valued in the merged company.
Sounds like successful M&A requires more than just financial smarts. You need strong leadership and a real understanding of how people react to change.
Couldn't agree more. Now, let's switch gears a bit. How about we talk about how M&A activity can be a sign of broader economic trends? What can you tell us about that link between M&A and the economic cycle?
Well, it seems logical that when the economy is booming, companies are more likely to be in the mood for acquisitions. They have more cash flow, and they're feeling confident about investing in growth.
That's right. When the economy is expanding, we usually see a surge in M&A activity. Companies are optimistic, access to capital is easier, and there's a general sense of, let's make a deal.
Like a rising tide lifting all boats.
Precisely.
So when the economy is doing well, companies are more likely to take risks and use acquisitions to fuel their growth.
Exactly. But on the flip side, during recessions or times of uncertainty, M&A activity tends to slow down. Companies get more cautious, focus on holding on to their cash, and might even sell off non-core assets to strengthen their financial position.
Makes sense. When times are tough, companies batten down the hatches and focus on what they do best.
Exactly. Although, those economic downturns can also create some interesting opportunities for strategic acquisitions.
How so?
Well, companies with strong balance sheets might be able to scoop up struggling competitors at bargain prices.
So it becomes a buyer's market.
You could say that. Think of it like, shopping for a used car when the seller is desperate to get rid of it. You have more leverage in the negotiation and might snag a sweet deal. It's the same idea with these distressed M&A situations.
That's a great analogy. Distressed M&A can be a way for companies to grab market share, acquire valuable stuff, or even enter new markets on the cheap.
Right on. It's fascinating how M&A activity can both reflect and influence what's happening in the economy. It's this dynamic interplay between market forces, corporate strategy, and financial considerations. Now, why don't we dive into some real-world examples to see how this all plays out?
Sounds good.
Let's start with a deal that many people thought would never happen. Facebook buying Instagram back in 2012. A cool $1 billion. Remember, this was way before Instagram became the social media giant it is today.
Yeah, Instagram was just a photo app with a bunch of filters back then. It's hard to believe it's now a key part of Facebook's advertising machine.
It was a bold move by Zuckerberg, and some people definitely question the price tag. But Facebook saw the potential in Instagram's rapidly growing user base, especially on mobile.
They were basically buying their ticket to the mobile revolution.
Exactly. And get this, the deal was structured as an all-stock transaction. Facebook paid for Instagram entirely with its own shares.
Interesting. So no cash up front, but they did give up some ownership to Instagram's founders.
Right. And it turned out to be a brilliant move. As Instagram's value exploded after the acquisition, the value of those Facebook shares went through the roof, too.
Talk about a win-win. It really shows how the way you finance a deal can have a huge impact on a company's long-term financial success. For a different kind of example, let's look at the Kraft-Heinz merger back in 2015. A massive $62 billion deal.
Ah, yes, the merger of two iconic food giants. On paper, it looked like a perfect match. Both companies had long histories, strong brands, and a global reach. But the integration wasn't easy.
Yeah, I remember reading about some of their struggles. They were aiming for big cost savings, but actually making those cuts proved to be tough, right?
It was. Combining two huge, well established companies is never a walk in the park. There were clashes in culture, problems integrating their different systems and processes, and those projected cost savings were harder to achieve than they thought.
It's like trying to mix two different recipes. Sometimes the ingredients just don't work together.
Exactly. And in the Kraft Heinz case, the merger didn't quite deliver the financial results they were hoping for. They had to write down the value of some of their brands, which basically meant the deal hadn't lived up to the hype.
Ouch. That's a big reminder that even with the best intentions, M&A deals can hit unexpected roadblocks. It's not just about the deal itself, it's about that long and complicated integration process. Speaking of unexpected hurdles, let's bring back those regulatory bodies. We touched on them earlier, but I think it's worth a deeper dive.
Absolutely. Regulatory bodies like the Department of Justice, DOJ, and the Federal Trade Commission, FTC, here in the US, have the power to review and either approve or block proposed mergers. They're like the watchdogs, making sure these deals don't crush competition or hurt consumers.
So they're like the referees, ensuring everyone's playing by the rules. What do they actually look at when they're reviewing a merger?
One big thing is the impact on market concentration. If a merger would create a monopoly or seriously reduce competition in a specific market, that's a red flag. They also look at how it might affect consumer prices, product quality, and innovation.
So it's not just about stopping monopolies, it's about protecting everyone's interests.
Right. And they don't just automatically approve every deal that lands on their desk. They can add conditions to a merger, make companies sell off certain assets, or even completely block the deal if they think it's a bad idea.
Wow, that's a lot of power. Can you give us an example of a big merger that got caught up in regulatory scrutiny?
One that comes to mind is the AT&T and Time Warner merger we talked about earlier. The DOJ actually sued to block the deal. They argued that it would give AT&T too much power over content and distribution, which could lead to higher prices for consumers.
So it was a legal showdown. What happened?
After a long fight, AT&T ended up winning the case and was allowed to go ahead with the merger. But it shows how these regulatory hurdles can add a ton of time, cost, and complexity to the whole M&A process.
It sounds like companies need to factor in the regulatory landscape when they're planning their M&A strategy. They can't just assume everything will be smooth sailing.
Definitely not. Getting regulatory approval is a crucial step, and companies need to take it seriously.
Well, we've covered a lot in this second part of our deep dive. We've seen how M&A is affected by the ups and downs of the economy, explored some interesting real-world examples, and learned about how regulatory bodies can make or break a deal. But there's still more to unpack, right?
You bet. In the final part of our deep dive, we'll look at how technology is changing the M&A game, talk about the ethical considerations involved in these deals, and leave you with some food for thought as you navigate the always changing world of mergers and acquisitions.
We've covered the strategies, the financials, and even the regulatory hurdles. But there's another force at play here that's reshaping the M&A landscape: technology.
Oh, absolutely. It's amazing how much tech has transformed M&A. It's not just tech companies buying each other anymore. Tech is changing every industry, and we're seeing that reflected in the deals being made.
Yeah, you're right. Look at Amazon buying Whole Foods. That was a tech giant jumping headfirst into the grocery business.
Exactly. And it's not just Amazon. We're seeing tech companies acquiring businesses in healthcare, finance, transportation, you name it. They're after data, talent, new ways to grow.
So tech is like the wild card, shaking things up and creating these unexpected partnerships. What are some of the specific technologies driving this trend?
Well, artificial intelligence, or AI, is a big one. Companies are using AI to crunch massive amounts of data, find potential acquisition targets, and even predict how successful a merger might be. It's like having a superpowered financial analyst at your fingertips.
That's wild. So AI is taking some of the guesswork out of M&A, helping companies make smarter decisions.
It is. And then there's cloud computing. It's making it so much easier for companies to integrate their operations after a merger. No more clunky old systems. Everything can be seamlessly connected in the cloud.
So cloud computing is the glue that holds these merged companies together, making integration smoother and more efficient.
Exactly. And let's not forget about blockchain. It has the potential to completely revolutionize how M&A transactions work.
Blockchain, the technology behind cryptocurrencies, what does that have to do with M&A?
Well, imagine a world where all the documents, the contracts, the financial records involved in a merger are securely stored on a blockchain. Everyone involved can access them in real time. No more waiting for emails, no more delays because of paperwork.
That sounds incredibly efficient, like removing all the friction from the process.
Exactly. And that's just one example of how tech is disrupting the old ways of doing M&A.
This is really fascinating. It's like we're seeing the tech world and the financial world colliding, and technology is changing how businesses merge and acquire each other.
It's an exciting time to be watching this space. But before we wrap up our deep dive, I want to bring it back to our listeners. We've been talking about these massive billion-dollar deals, but what about smaller businesses or individual investors? How do these concepts apply to them?
That's a great point. Not everyone's out there buying Fortune 500 companies.
True, but the principles we've discussed apply at any level. For a small business owner thinking about acquiring a competitor, the same due diligence process is important. Understanding valuation, financing options, integration challenges, it's all crucial, even on a smaller scale.
So it's like a mini version of what we've been talking about, but the core concepts are the same.
Exactly. And for individual investors, paying attention to M&A trends can actually help them make better investment decisions. Knowing which companies are being acquired, at what price, and why, that can give you some valuable clues.
So it's like getting a glimpse into the future of different industries and companies.
It can be. Let's say you see a company in your portfolio becoming a frequent target for acquisitions. That might be a sign that the industry is consolidating or that the company is undervalued.
That's definitely helpful information for any investor. It can help them make smarter choices about their portfolio.
Absolutely. Now, as we wrap up this deep dive, I want to leave our listeners with something to think about. As you look at the industries you follow, what potential M&A deals do you see on the horizon? And what factors could make those deals succeed or fail?
That's a great question. It really challenges our listeners to apply what they've learned and think critically about the future of M&A.
It does. And remember, the world of M&A is constantly changing. New trends pop up, industries merge, and technology keeps shaking things up.
So it's all about staying informed and being flexible to navigate this dynamic landscape.
Couldn't have said it better myself. Well, it's been a pleasure sharing my insights with you today.
It's been incredibly insightful. A huge thanks to our listeners for joining us on this journey into the fascinating world of mergers and acquisitions. We hope you've come away with a better understanding of this complex and ever-changing field.
Keep exploring, keep learning, and keep diving deep.
And remember, knowledge is power.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.